Most retirees set their portfolio allocation early on in retirement, and then they never really adjust it. What they don't realize is this one oversight could potentially cost them a secure and comfortable retirement. Now, instead of just explaining this to you and explaining the importance of making these portfolio adjustments, we're going to walk through a client case study. Now, we've changed the names and simplified some of the financial details so we can prioritize and focus on what's important. But I think as you start to see how the financial plan integrates with what your portfolio should look like, it's going to make a lot of sense as you determine what your portfolio and plan might look like as well. So what we can see here is Eduardo and Anna. Now, Eduardo and Anna originally planned to retire at the end of 2022. But what came to happen is in 2022, they, along with a lot of other people, were invested pretty heavily in tech stocks. And while they wanted to retire at the end of 2022, their portfolio dropped in value over 25%. Now, not only that, but at the end of 2022, and this is before we were doing any work together, they had no idea how long that downturn would last. Was it going to drop another 25% the following year? There was still inflation concerns, global concerns, all kinds of things that caused them a lot of fear and actually prevented them from retiring. Now, thankfully, 2023, things rebounded nicely. And at the end of 2023, we started doing some work together to say, what might this need to look like so that when we do retire, we don't need to worry about what the market's doing. We don't have to worry about maybe having to go back to work because of another 25% downturn. And on top of this, and this was the key question, they were smart to ask it, how do we make continuous adjustments throughout retirement to make sure that our portfolio is constantly adapting to what we need it to look like? So that's exactly what we did, and that's what I'm going to show you by taking a look at their plan today. So as we can see, as we introduce you to Eduardo and Anna, Eduardo is 65, Anna is 64. I've simplified some of their investments just to consolidate and make this as simple as possible to walk through, but Eduardo had about $825,000 in his 401k. Anna had a little over $1 million in her rollover IRA, and then they had a combined investment account of about $616,000, along with their home that had been paid off, and their home was worth about $1.1 million. Now, when they came to us, it was pretty clear they had done a good job of saving. They invested, they had saved, they had paid off their home, they had put themselves in a very secure position to retire. The next things that we looked at was what did they want to do in retirement? And they shared with us they didn't have incredibly extravagant goals, but they had 4 kids and 9 grandchildren, and they all lived nearby. And really more than anything, they wanted time to spend with their kids, with their grandchildren, because family was very important to them. They weren't wanting to take crazy cruises and extravagant vacations. They just wanted to prioritize time with family and have the ability to take some vacations here and there. So they wanted to retire now, and their expenses in retirement, when we walked through their budget, were about $6,600 per month. In addition to that, we were planning for healthcare expenses. So we are projecting out their Part B and Part D premiums based upon their adjusted gross income, and then planning on an additional $4,200 per year for each of them in out-of-pocket expenses. Additionally, we wanted to plan for a new vehicle every 5 years or so, one for Eduardo, one for Anna, really every 10 years, meaning overall, one vehicle every 5 years. Now, as is the case, what this usually means is maybe their current vehicle is worth about $10,000 by the time they sell it. They combine that with this $25,000 to purchase a new or maybe lightly used vehicle at that time. So that's what we're planning for. These are their goals. So as you can see, pretty straightforward here. And really their question, their fear was, James, we don't want to retire, spend time with family, get comfortable doing this, and then all of a sudden another downturn means, hey, we got to go back to work. And now we can't find a job. And now we're struggling to get by. So what do we do with our portfolio to prevent that? So before we can answer that question, the next thing we looked at was their income. Now, Anna had a little bit of a pension. She was receiving $600 per month. This was not receiving a cost of living adjustment, and it was over her lifetime only. So she had $6,000 a month. And then Eduardo had his Social Security benefit, which he was planning to collect at age 70. And the benefit at his full retirement age, so at his age 67, he could have collected $2,850, which means at 70, he would have 3 years of delayed retirement credits, which means 8% annual increases from there. Anna's benefit at her full retirement age was $2,500, so her benefit at 70 would be higher as well. So these were their income sources, and the next thing that we wanted to look at was we wanted to look at their retirement cash flows. So we go to their cash flows next because this paints a picture of year by year what income's coming in, what expenses are going out, and how does their portfolio play into the picture, because that's ultimately going to help us answer the question of how do we invest our portfolio to support the desired income that we have as we move throughout retirement. So if we start on the income side, they're retiring right now. The income sources they're going to have, you see there's no more salary because they're done working. What they will have is Anna has her pension of $600 per month or $7,200 per year, but there's no cost of living adjustment on that. Meaning the dollar amount is the same every year, but every year as inflation goes up, the purchasing power of that pension starts to diminish just a little bit. Then they have Social Security. But as you can see here, they're not planning to collect until age 70. They wanted to maximize both of their benefits to say, can we lock in a pretty strong income base between Social Security and Anna's pension so that we have that throughout retirement, regardless of what happens to our portfolio. So you can see Eduardo's benefit here starting at 70, Anna's benefit starting the following year, also at 70, and you can see that combined amount in this column right here. So as we go back to their total income, what this is showing is here's those total income flows as we add up pension and Social Security each and every year throughout their retirement. What we always want to compare that to, of course, isn't just what income do they have coming in, it's what are their goals. In other words, what are their expenses? What is it going to cost to do what they want to do, to have their monthly expenses paid, to have a new car paid for, to have medical expenses paid for? As we drill down into their expenses, what we can see here is here's their living expenses. So $6,600 a month comes out to $79,200 per year, and we're adjusting that for inflation each year. And then on top of that, they have healthcare expenses. So healthcare expenses, that's gonna be made up of their both Medicare Part B and Part D premium, as you can see for Eduardo here. And then we're planning for an additional $4,200 per year of out-of-pocket costs. Doing the same thing for Anna as well on her healthcare benefit. So as we look at their total expenses, it's yes, what they want to live on, which is the $6,600 per month, but they don't want their healthcare expense coming out of that. The healthcare expense is separate. So that's what we're planning for there. In addition to that, we have their goals. Every so often, we're going to be projecting them buying a new car. And so that's what this expense is here. And then finally, what's the projected tax payment? Now you can see a bunch of zeros here. This is before we do any tax strategy and tax planning. As some of you may have noticed, they have a lot of money in pre-tax accounts. So one of the tax strategies that we're going to implement is can we do some strategic Roth conversions along the way to fill up some of those lower tax brackets so that, as you see, if we fast forward into the future, they're not paying these really high tax bills every single year as required distributions kick in. That's an analysis for a different day. What we want to talk about today is really the investment component of what they're doing. But as we add these expenses up, you can see here's our total outflows in this column here. And total outflows is showing us what's the total expense that you need. What's the total amount that you need coming in so you can pay taxes, pay healthcare expenses, pay for a new vehicle every 5 years, and then have $6,600 per month in today's dollars left over to spend on the things that you want to spend money on. Well, the final step here is saying what are these total outflows and then comparing that to their inflows, comparing that to the income sources they have. Well, as we see this, the difference is net flows. The difference means this is what your portfolio has to generate, and this is what we're going to drill down into next to say, how do they need to position their portfolio in order to generate these flows to supplement pension, to supplement Social Security, to give them the income they want and not have to worry about what's happening in the stock market. So here's what we want to do next. We wanted to protect Eduardo and Anna against a stock market downturn. Now, how do we do that? It's not a perfect science, unfortunately, because we have no idea how long the next stock market downturn will last. What we do know, though, is we know historically speaking how long they tend to last on average. The average bear market in the S&P 500 lasts about 2.5 years. When you measure the market hitting its peak or its all-time high, then dropping 20% or more, and then recovering to its peak value. Some are much longer, some are shorter, but on average, that's about 2.5 years. Now, we can double that because for the most part, the majority of bear markets have broken even within about 5 years. So if we have 5 years of reserves set aside, what that tells us is we can invest the rest in something that's more growth oriented, in stock-like investments. And we can't guarantee that 5 years is going to be long enough, but what we do know is that's going to dampen, it's going to take the brunt of the hit of a serious market downturn. So we have 5 years of more stable assets, more reliable assets that aren't subject to crazy fluctuation. That's a good place to be to help to withstand the market downturns and help to protect against what you might call sequence of return risk. So let me walk you through how we did that for Eduardo and Anna. If you add up these numbers, if you want to take the time to do so, you can see these numbers here add up to about $490,000. What we did next is we took all those numbers and put it on this portfolio design worksheet that we create for clients. Here's what this is showing. The total portfolio value that Eduardo and Anna have is about $2.45 million. Now, when we're looking at portfolio construction though, yes, we want to know the total value of the portfolio, but we also want to know what we're considering the primary withdrawal account, and sometimes this is multiple accounts. The primary withdrawal account is essentially telling us what accounts will we be taking income from first over the first 5 years. Well, in their case, it was their brokerage account, which is about $615,000. If you exclude the brokerage account, the remaining accounts are worth about $1.835 million. Now, we're still planning for those. We still want to invest those, but they're probably not going to be where we're taking income from the first 5 years. This has to do with tax strategy. This has to do with a number of different things. But for Eduardo and Anna, the brokerage account was their primary account. Now, here's where we went from there. Next thing we said is how much do we need from your portfolio over the next 5 years? Well, as we saw, that's about $490,000. That was on the cash flow page. We said year by year, what's the net flows? What's the responsibility of the portfolio here? If you add those 5 years up, we need about $490,000. So if you look at it, $490,000, that represents about 20% of the total portfolio value. So the first thing you might think is, okay, great, we need 20% of the portfolio and something really conservative, and 80% of the portfolio can afford to be invested more aggressively, assuming you're comfortable with that. That's the right thinking, but it's still a little bit limited. Because remember, we're not going to be drawing evenly from all the different accounts. Or in other words, this $490,000, we need this to be available in the primary account because it's not going to do as much good if it's in these accounts, but we're not going to draw from those accounts for potentially several years. So here's where we go next. We say $490,000 represents 20% of the total portfolio, but if we take it as a percentage of the primary account, it's 80% of the primary account value. So the next line of thinking is, okay, if it's 80% of the primary account value, that means we should have 80% of the primary account and things much more conservative, and then 20% of it in maybe growth assets. Getting closer, but we're not there quite yet, because keep this in mind. All of these accounts are generating dividends and interest depending on the type of investments they're invested in. Now, those dividends and interest typically remain pretty resilient even as markets fluctuate. Even as the value of stocks and bonds goes up and down, for the most part, that dividend and interest is pretty reliable, assuming you're invested properly. That's why the next thing that we do is we say, what's the primary account estimated income? Well, $12,000. Where did that come from? Well, if you look at this report here that was generated separately, you see that this portfolio, this primary account's actually generating closer to $20,000 per year. We wanted to be pretty conservative because there have been instances in the past where dividends were cut. So we said, what if instead of counting on $20,000 a year of income from this part of their portfolio, let's cut that down to $12,000. So a 40% reduction just to be ultra conservative. Well, let's assume we can count on $12,000 per year, but the estimated income over the next 5 years might total $45,000. Because keep in mind, they're going to be drawing this account down, which means the income it's generating every single year is also going to gradually be dwindling. So if we can count on $45,000 of cash income over the next 5 years, then what we need and what we call root reserves here is about $445,000. Where does this number come from? Well, it comes from knowing we need $490,000 to be protected and insulated from market downturns. Of that $490,000, $45,000 is probably just going to come from cash income. That's a conservative estimate. The remaining amount, so $490 minus $45, this needs to be something in really conservative assets that isn't going to be impacted by that next market downturn. So when we look at this, we went back to Eduardo and Anna and said, from what we call risk capacity standpoint, risk capacity being what's the most amount that you can afford to have in stocks before this becomes too dangerous and detrimental to the health of your long-term plan. We said we'd want 70% of your primary account to be in something more conservative, call that bonds. Bonds could be CDs, could be treasury bills, could be a number of things. We're just calling it bonds. And 30% in stocks. Where does that come from? Well, $445,000 divided by the account value is 70%. So we said, yes, the overall portfolio, if we go here, might only need to be 20% bonds and 80% stocks, but through strategic asset location of having the primary withdrawal account invested more conservatively frees us up to invest more aggressively with the rest of your portfolio so you can still reap the benefits of long-term growth, but you also still have the protection of that stable asset class if and when that next portfolio downturn hits within the first few years of your retirement. Now, this isn't the whole story. This is the risk capacity component of Eduardo and Anna. What's the most you could afford to have in stocks without jeopardizing the long-term health of your plan? It doesn't necessarily mean this is the right allocation. There's also what you might call the risk tolerance aspects of this. So what's your comfort level with ups and downs in the market? 80% stock, 20% bonds, we think based on long-term returns, that's an appropriate portfolio for your financial plan. That's if we take your emotions out of it. That's if we completely strip this of any emotional reaction to the ups and downs, which we can't do. We had to ask them, we had to go through the conversation. If this causes you not to be able to sleep at night, maybe it's the wrong allocation, but from a financial perspective, this is what we feel comfortable with as we tie your portfolio into your overall financial plan. But here's what I want to show you next. This is what Eduardo and Anna were really wise about at the beginning. They knew that it wasn't a set it and forget it allocation. It's not an 80-20 mix forever throughout retirement. They wanted to know, how will you adjust this on an ongoing basis? And that's what I want to show you next. Let's go back to their financial plan. Their financial plan says here's the amounts that they need to take from their portfolio the first 5 years of retirement. Well, what about after those first 5 years? Assume the first 5 years come and go, and regardless of ups or downs in the market, Eduardo and Anna could handle it because they had the right asset allocation to protect against market downturns while also still benefiting from markets growing over time. Well, as we look at this projection, what you start to notice is when they both turn 70, Social Security kicks in. When Social Security kicks in, more income's coming from there, which means less income has to come from their portfolio. So as you see the net flows here, you can actually start to see that those drop dramatically. Now, not only are the net flows, meaning the withdrawals, dropping dramatically, but if their portfolio grows over time, you have a larger portfolio balance that has to support lower and lower portfolio withdrawals. Now, of course, no growth rate is guaranteed, but if we take a look at this, based upon some assumed growth rates, what their portfolio might look like at age 70, and this is assuming about a 6% or so rate of return, not a guarantee that they'll get it, but just a projection, they might have about $3 million in their portfolio at that time. So what we told Eduardo and Anna is we said, look, year by year, we'll be updating this and revisiting this to see, do we need to make any portfolio changes? But let me just walk you through a hypothetical of what might that look like in 5 years, assuming these growth rates happen, assuming these withdrawals happen, assuming what we're looking at here in your plan is actually what your portfolio looks like at that time. So we said, remember these numbers. Call it $3 million in your portfolio, and here's the amounts that you might need to take out of your portfolio at that time, based upon your projected income flows and based upon your expenses here. Well, under those assumptions, we created this other portfolio design worksheet for them. Of Eduardo and Anna, here's your $3 million. And now your primary account is actually both your brokerage account and your IRA at this time. And the reason for that is you're going to be drawing some from your brokerage account, but your required distributions are also going to kick in, which means you're going to be required to be taking money from your IRA at this point too. So your primary account, technically, as we're looking at this here, is your entire portfolio of $3 million. $110,000, that's the amount, if you add up the amounts they'll need from their portfolio from age 70 to 75. And granted, this is just a projection. We'd actually go through this at the time with them. We expect they'll need about $110,000 from their portfolio from ages 70 to 75. Now that represents about 3.6% total of their portfolio value. Now, if that represents 3.6% of their total portfolio, also represents 3.6% of their primary accounts, because we're assuming their primary accounts are all of them. Well, the estimated income on this portfolio, $3 million portfolio, we assume it can generate 2% in dividends and interest. That's $60,000 per year that's generating income. If we assume that income amount for 5 years, that's $300,000 of income that could be generated from that portfolio. And here's what we're doing. We're saying, here's the total amount you're going to need, $110,000, at least the projected amount. Here's a total amount that's going to be generating cash, dividends, and interest before you even have to dip in to the principal of your portfolio. When we look at this, how much do you need in what we're calling root reserves? Well, the reality is you don't need anything. From a risk capacity standpoint, your cash interest and cash dividends are covering all of your income needs. So if we look at this, you could afford to have your primary accounts be 100% stock, 0% bonds. Not saying you should necessarily do that, but from a risk capacity standpoint of how much risk can you afford to take before it becomes dangerous, well, you could afford to be 100% stocks. We said, Eduardo and Anna, we're going to have the conversation at that time of, do you really feel comfortable with that? Do you feel comfortable knowing that a $3 million portfolio could be $2 million 12 months later with an average bear market? Or do you want to have a smoother ride, a more balanced ride with your portfolio? But as we look at it, as we try to engineer the right portfolio, it says, through a combination of cash income and root reserves, how do we protect against those downturns while also freeing your portfolio up to continue growing to keep up with inflation? This was the exercise we went through to help them understand what that might look like. Now, one thing I want to emphasize is this could go the other way too. In Eduardo and Anna's case, we showed, look, higher levels of income coming in retirement as Social Security kicks in and a greater portfolio value. What does that mean? What are the implications? Well, it means you need less and less and more conservative assets over time. Doesn't mean you should have less and less, but it means you need less and less. The alternative could also be true. What if you're spending down more of your portfolio throughout retirement? What if you have less income later on in retirement because maybe you have a part-time job or some income source that goes away later on? So this isn't necessarily a universal application, but this shows the framework and the process we went through to help Eduardo and Anna understand, number one, how should you be allocated today? And then what will we be doing on an annual basis to ensure that portfolio is staying up to date with what your financial plan requires? So what was the end result for Eduardo and Anna after we went through this? Well, number one, they had a very clear sense of how does their portfolio connect to their overall financial plan, which is ultimately connected to their goals and what they want to have happen. It's not like their plan is here and their portfolio is here. It should be very much be an integrated process where the portfolio ties into what their plan is doing. Number two, we were able to diversify their portfolio, not just into a cookie cutter mix for the average retiree, but something that was customized and specific for them. And for them, I mean their specific income needs, their planning needs, their goals, and their vision for what they want retirement to look like. And number three, and most importantly, they no longer feared that next downturn. We fully set expectations. There will be more market downturns from here on out. Your portfolio will drop when that happens, but we have the right assets in place. We have the right investments in place to protect against that, regardless of whether that downturn lasts for a year, 3 years, or 5 years. You've got protection in place while also protecting against the long-term impact of inflation by having enough of your portfolio continuing to grow by being invested in more of a growth allocation. So as we walk through this, I know this was just showing you the high-level mix of stocks and bonds and why we came to that conclusion. If you want to see how we actually diversify something, not talking about specific returns or anything like that, but how do you actually choose specific funds or asset classes for your portfolio needs, well, we made a video here. And in this video, we walk through how do you actually come to those conclusions, or how do you actually come to that actual allocation based upon your financial plan, and that video will show you how. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.